Rent is one of the few expenses that seems to move in only one direction, up. Groceries sometimes go on sale. Fuel prices occasionally dip. Electronics often become cheaper over time. But rent, once it rises, it rarely comes back down. Many people notice that even when inflation slows or when the economy improves, rent continues to increase. This leads to a frustrating and very common question. Why does rent increase faster than most other prices? And why does it almost never fall? To answer this, we need to look beyond simple inflation headlines and understand how housing markets, supply limits, and long-term costs actually work. Most everyday products are priced based on competition and production. If a company produces too many televisions, prices drop. If demand for a certain food declines, sellers reduce prices to avoid waste. Housing works very differently. Rent is tied to long-term assets, not short-term goods. A rental property is not something a landlord can quickly produce more of when demand rises. And it's not something they can easily remove from the market when demand falls. Because of this, rent behaves more like a fixed financial commitment than a flexible consumer product. Once rent rises to cover higher costs, it becomes the new baseline. One of the biggest reasons rent rises faster than other prices is limited supply. New housing takes time to build. It requires land availability, government approvals, construction materials, skilled labor, financing. Even when demand for housing increases rapidly, supply cannot respond quickly. This imbalance means that when more people are looking for homes than there are homes available, prices adjust upward, and they tend to stay there. Unlike products that can be mass-produced, housing supply moves slowly, creating persistent upward pressure on rent. Another major factor is where people want to live. Over time, jobs, education, healthcare, and opportunities tend to concentrate in cities and urban areas. As more people move toward the same locations, demand for housing increases in those areas. However, land in cities is limited. When more people compete for the same number of apartments or houses, rent increases faster than average inflation. Even if the national economy cools, local housing demand can remain strong, keeping rents elevated. Rent is often adjusted based on costs landlords face. These costs include property taxes, maintenance and repairs, insurance, utilities, loan repayments. When these costs rise, rent is often adjusted upward to compensate. The key issue is that most of these costs do not fall easily once they increase. Property taxes rarely decrease. Insurance premiums tend to rise over time. Maintenance costs usually increase as buildings age. Because landlord expenses move upward over the long term, rent follows the same pattern. Housing is a basic need. People can delay buying a new phone. They can switch brands or reduce consumption, but they cannot easily stop needing a place to live. This makes demand for housing relatively stable, even during economic slowdowns. When demand does not collapse, prices do not collapse either. Rent may grow more slowly during difficult periods, but it rarely declines significantly because people still need housing, regardless of economic conditions. Once rent increases, it often becomes embedded in future pricing. When a new tenant signs a lease at a higher rate, that rate becomes the reference point for future increases. Landlords typically adjust rent based on previous rental prices, market averages, comparable properties. If surrounding rents have increased, lowering rent becomes unlikely unless there is severe oversupply. This creates a ratchet effect, where rents move upward in steps but rarely move backward. Inflation plays a role, but it doesn't explain everything. Inflation measures how fast prices are rising, not whether prices are high or affordable. When inflation slows, rent increases may slow as well, but the existing high prices remain. This means slower inflation is not lower rent. Lower inflation is not cheaper housing. Rent responds to inflation by setting a new minimum level, not by reversing past increases. Many rental properties are treated as long-term investments. Investors expect stable cash flow, predictable returns, protection against inflation. Because of this, rental pricing is often based on long-term financial planning rather than short-term market fluctuations. Lowering rent can reduce perceived property value and expected returns, so landlords are often cautious about cutting prices unless absolutely necessary. Rent is usually the largest monthly expense for most households. Even small percentage increases can feel significant. A 5% increase in rent impacts monthly budgets more than a similar increase in smaller expenses, making rent inflation more noticeable and emotionally impactful. This psychological effect reinforces the feeling that rent is rising faster than everything else, even when other prices are also increasing. Before we wrap up, take a moment to think about how rent has changed in your own experience. Have you noticed it rising faster than other expenses where you live? Or have you seen different patterns in your city or country? If you have a perspective to share, feel free to leave a comment below. Your experiences help add real-world context to these discussions. If you found this breakdown helpful, consider giving the video a like. It helps support the channel and lets YouTube know this content is useful. And if you're interested in clear, calm explanations of everyday economic topics, without hype or exaggeration, you can subscribe to the channel for more videos like this. In the next part, we'll look at why rent rarely comes down, even during economic slowdowns, and what conditions would actually be required for prices to fall. Thanks for watching, and I'll see you in the next video.